We want people to come into this business and understand that hard money is a stepping stone. They're going from here, but they also need to know where they're going. Hey everyone, this is Mike Bond with Hard Money Mike. Today we're going to go over one of the most asked questions that I come across, and that is when I'm starting out, who are the players, who are the people we can borrow money from, and how do I get from hard money, maybe partnerships, all the way to where you're using lines of credit to buy and trade properties. We want to make sure you get from one end to the other end in the ladder of funding. You may start out with a partnership or hard money, but we want to get you to the Wall Street kind of money, and then to bank money, and then to lines of credit or real OPM, or even just your cash. But how do you do that if you don't know the players, if you don't know how to move from one to the other, and what are the benefits of each one, and where do you find them? I want to remind everyone that funding is at least half of what makes investing successful. Yeah, you have to buy good properties and you have to buy them at a good number, but you also have to have the right funding. Sometimes that right funding is funding that's fast. So you could buy the properties that are available, the good ones that are available that need to close quick. Sometimes it's just getting the money that's cheapest because you need better cash flow. Better financing will make properties go from good to great. And next, you need easy or certain funding. You want to make sure it is easy for you to apply and get. There's not a lot of runaround making sure you're going to get the funding or maybe not. And you also want to make sure it's certain, because the people who are selling properties, if they know it is certain that you're going to close, you're going to get the better deals. I have a client in Oklahoma. He has gone from buying 5-10 properties a year to last year he bought 36. This year he's planning on buying 47. All these properties come to him and he closes them quickly because now he's gotten to the point where he just uses his lines of credit. If he likes a property, he could buy it in days, hours, or weeks. Whatever works for the seller, he is ready to fund at a drop of the hat. That's where you want to get to. That's where we want to get everyone to. We don't want people just to come into hard money and stay there, or even get into private money and stay there. We want them to get from partnerships or hard money all the way to lines of credit. But to get there, you have to understand who are the players and what does it look like when you're new to investing, and who are the people who can help you. Typically, most people will start out in either partnerships or hard money. Now, partnerships are great because you don't have to provide any of the funding. The partner will provide all the funding, maybe even some expertise. The negative about a partnership is typically they're going to take at least 50% of the profits and probably be a little too involved in the project. But when you're starting out and you need some experience and you don't have the money, this is a great way to go too, because you could do 2 or 3 deals, build up your experience, build up your cash bank, and go to the next level. I want to emphasize, as we go from level to level, what happens is you're accumulating more money because you're saving more money. Every time you step up, you're going to put more money into your pocket and have available to you more deals at better pricing. Second is local hard money. So what I'm talking about is asset-based lending for real estate investors. This is what hard money used to be until they started changing the name to private money. And sometimes it gets a little confusing. Hard money, private money, fix and flip loans, rehab loans. It all comes down to what do they do as far as a lender and what do they cost you. But what you get from hard money is true investor grade financing, where they can go up to higher loan to value, so you don't have to put as much in to the property. They will be flexible. They will look at different deals. Maybe it's a land deal. Maybe it is a unique property, or maybe a small commercial. Hard money and local hard money will be flexible and maybe not look at your credit score. So if your credit score is not the 680 or 690 or 700 that lenders want, there's an option with hard money. Also, experience. They may not require any experience as long as the deal is solid and good. Hard money is typically fast also. So if you need to close something in 5 days instead of 10 or 30, you go to hard money or local hard money. Now, typically the negatives are it's local. It's a small fund or a small group of people that have money together. So they may run out of money. They do not always have money at hand. So you got to check that. They also are a little bit more expensive. It may cost you a point and a half more than when you go with the Wall Street private money. So we started with partnerships. We've gone to hard money. Next is what I call Wall Street private money. It's all these large companies, these large firms. The best part about them is they have typically unlimited funds. Between hard money and private money, the interest rates are very much in line. Sometimes hard money is actually cheaper on the rates. But on the cost and point, what you're going to find is they are typically, a point to point and a half cheaper than hard money. The other benefit of private money is they could lend in multiple states and multiple regions. Typically your partnerships or even private money, even some of the local banks, are not going to lend out of their comfort zone or their state or their region. These large firms, they don't care if you have a property in Florida and then Maryland, California, wherever. They will lend where the properties are and they'll follow you, and it'll help you grow as you go through your process. They typically also could do longer terms. It's not uncommon for them to do a 12 or 18 month. I never suggest people doing standard fix and flips to do more than like a 6 to 9 month loan, because what it does is it eats away at your profits. Every month it's out there, there's interest being paid, there's taxes, there's insurance. So you're just eating away. So fix and flips, even though they give you a longer term, maybe that's not a positive, but it is, especially if you have a larger project. So once again, what we're looking at doing here is going every step to make it easier and more profitable for you, meaning we want to get from partnerships to hard money to private money. Now the negatives for the Wall Street private money is they have a box. If you don't fit in their box, it doesn't matter. They find enough people who do fit in their box, so they won't think outside. If something's unique, if something is rural, if some of those things, they're not going to go there. Typically, they're going to want some experience, somewhere between 3 and 5 to get their best rates, to get their best terms, so you don't have to bring in everything and mortgage, your house and everything just to get this deal done. They're also going to require that you have a decent credit score. It changes, but right now it's a minimum of 660, but really what they're looking for is credit score 720 and above. Another thing that we see as a negative is they won't give you any escrow advances. So when you close, they may fund 100% of your escrow or your fix-up or your repair, but they're not going to give you any advance to start. They just ask you to put some money down. They ask you for some reserves and some other things. Now they want you to start the project. So if you have like a $50,000 or $60,000 budget to fix up the property, they want you to put in that first $15,000 or $20,000, and then they will reimburse you. So once again, a negative is they're not going to give you any money up front to start the repairs. They want you once again to take it out of your pocket, and then they'll give you the money. So that sometimes stalls projects. They are more bank-like than they are hard money as far as what they require for monies in, reserves, all those kind of things, including credit scores. Because you're waiting for draws, you're waiting for them to get you the money. And if every month that it stalls costs you more money, maybe costs you missing the market, that is one of the biggest negatives I see about private lending. So now we've gone from partnerships to hard money to what I call Wall Street private money. The next are local banks. Local banks, there's a lot of smaller local banks or mid-sized banks who love to lend to real estate investors. The positives, they're going to be cheaper. With inflation and the Fed, what they're doing it's became a little bit closer in what they do, but it's still 1 to 2 points cheaper on the interest rate, even compared to the Wall Street money. Points, costs, they're going to be very similar to what the Wall Street money, but every penny that you can save in interest puts it back into your pocket. The negatives with local banks is, of course, the speed. Sometimes it takes 2 to 4 weeks minimum for them to fund a deal, so you may miss out on deals. Even local banks, they're going to be just like the Wall Street money. They're going to require certain credit. They're going to require certain monies down and experience. So they're going to want to see all three of those things. Another caveat as you go through this, even with the most experienced investors, they always have funding available. Even if they're into using their own money or OPM, which we're going to go through next, they still have a private lender or a hard money lender or even a partnership in case a unique deal comes up, a great deal, something that needs to close fast. They always have money for every project. But the biggest benefit that you're going as you're walking through this, like I said, even if you're saving 1 point on the origination or 1 point on the interest rate, every penny of that goes back into your pocket, which makes everything more profitable. Just think if you have different deals and one person makes $20,000 and the other person makes, $30,000. That extra $10,000 adds up over time, especially if you're going to do 4 or 5 deals every year. Next, what I call is real OPM, and this is something that everyone should be working on in getting if you're experienced or not experienced, you're just starting out. What I say when I'm talking about real OPM, these are the people that are real people out in the streets who are not in the lending business. They may be a doctor, dentist, it might be just someone who's retired, a teacher or whatever, who has some money. guess what? They're out there looking for better returns also. You could go to them and you could give them a secured return and still get better rates than you can at a bank, credit union, private lender, any of those things. So when you find, and if you have any questions on how to find or how to attract real people's money, let us know. But there is nothing out there that's faster, cheaper, and easier to get. Once you build a relationship, you have people who are looking for you as much as you are looking for them. So you could call someone and say, hey, I have a deal to fund. They like your experience or they just like you on what you do, they're going to fund it. There's no underwriting, there's no checking credit, there's none of those things. And more than likely, they'll fund up to 100%. So real OPM is something that everyone should be looking at, even if you're new in real estate investing. And last, where you want to get to besides the real OPM and making sure you have a mix of all of these lenders out there at all times is lines of credit. So as you accumulate properties, as you get more in your rental pool or whatever it is, you want to be able to get a line of credit on those properties. This is where banks, who used to be slow, can now offer you a product that's very quick, very fast. So it's like a big HELOC, but you may have 5 or 6 properties that have some equity in it, and it's just sitting there. So you go get a line of credit from a bank, they put it on your properties, and then when something comes up, when a wholesaler finds a deal or a realtor finds a deal, you're able to just go write a check, buy the property. That's why some people make more than others, is all the wholesalers, all the sellers go to them because they know for certain they're going to close. They know they have the money and they can do it quickly and with certainty. So once again, you're going to go from, this ladder, and you can skip around. It goes from partnerships to hard money to Wall Street private money to local banks. Anytime during this, you could, find real OPM, real people who have money, who want to make more money than they're making now with the banks. The banks are not paying them. You could pay them better than the banks, and you can still win. And last, lines of credit. As you accumulate, as you get there, you want to get to the point where you have lines of credit. So the only time you use it is when a great deal comes in. You could close on it quickly, and that's where you really start making more and more. That's where the momentum kicks in, because all these wholesalers are going to be sending you deals, realtors are going to be sending you deals. You could close them quick, and there's going to be better margins in them. So that's kind of the path. That's the players out there. We have the partners, we have the hard money, we have the private, we have the banks. One thing that's true, especially through the first 4, if you want to get through these steps quickly, the number one thing is credit score. The better your credit score, the better terms you're going to get. Even if you don't have experience, but you have an 800 credit score, lenders are going to look at you differently than someone who has a 600 score. If you don't feel that's fair, it's just the way it is, because most of these lenders are, just computer underwriting everything, so a credit score matters the most. As you go through this, work on your credit score. One trick that we always talk to people about on their credit score: get your business off your personal credit cards. 80% of the people that we work with, the reason their credit scores are lower is because they use their personal credit cards to fix a property, to run their business, all those things. Balances go up, their credit scores go down. So the number one thing you should also be working on is getting business credit cards. That's the quickest way, if you're using your cards, to raise your score and keep your score high as you go through this ladder. You want to make sure you go quickly, because every part is more money in your pocket. And if you need help with that, if you need to understand the business credit card side, just reach out to us. If you have a deal, or if you just want to discuss exactly how do I get from level 1 to 2. We want people to come into this business and understand that hard money is a stepping stone. They're going from here, but they also need to know where they're going. Even if it's just a referral to a better source. That's what we're here to do, is we're here to help educate people so they feel comfortable in what they're doing. Money is over half of this investing. To make it easier, you just need to understand the laws and how it works. It's very simple as long as you're working with someone who wants to help you and not just put you into a loan. If you have any questions, we're here to help. My email is below. If you want to talk about how do you go from where you're at or hard money to the next step, reach out to us. Thanks for joining us today, and we'll catch you on the next video.